Preferred stock shares typically trade some capital appreciation for higher dividend yields. But should you buy preferred stocks? Probably not. Preferred stocks sound fancy and attractive, but don't get sucked in too quickly. First, preferred shares are still an equity investment. In the event of bankruptcy, a firm's debt holders are still getting paid before preferred shareholders. If a company is liquidated, the preferred shareholder is getting zilch. Recall that preferred stocks have aspects of bonds. Traditional bonds have a fixed maturity date. Preferred stocks don't. Preferred shares are like corporate bonds with a perpetual maturity. Talk about credit risk. Preferred stocks are also typically callable. If interest rates fall, the investor's upside potential is capped because the issuer would just call the preferred stock. This creates an asymmetric risk-return profile for preferred stocks. That is, the callability basically cancels out any upside from long maturities. Furthermore, companies usually issue preferred stock as a way to avoid a credit downgrading from taking on more debt or because they're simply unable to issue more debt. This alone should be a red flag. Lastly, while that fixed dividend sounds nice, and while preferred shareholders do have preferential claim to dividends, those dividends can still be deferred in periods of market turmoil, whereas conventional bond interest would be more reliable. Missed dividends due to suspension do not have to be made up later. The higher yield of preferred stocks does not adequately compensate the investor for these greater risks and inefficiencies. As usual, retail investors are probably wise to stick with traditional stocks and bonds.